Hey traders, this is Blake Morrow with Traders Summit, and I'm really happy to introduce Mr. Michael Robbins. He is an author of a brand new book. It's called Quantitative Asset Management, Factor Investing and Machine Learning for Institutional Investing. But also he's a professor at Columbia and also an asset advisor at Larson with 15 billion under management. Did I say that correct, Michael?
That's right. I'm the chief investment officer here.
Woo, man, that's B with a B. A billion with a B is a big number.
Yep. You got to deal in B's, like the Fed says. It's anything less doesn't matter.
Well, I'm really happy to talk to you, and I'm excited because as we were discussing before we hit record, we were talking about how what you do can really translate to the trading community because you have some past trading experience as well. I know you're a professor now, and you're an advisor there at Larson, but talk a little bit about your past career.
Yep, thank you, and glad to be here. I was originally a physicist, and that was a common career path to get onto Wall Street. Most of the people who started systematic trading, I don't know about most, but very many, were nuclear physicists, and a lot of the technology, a lot of the math came from that. And I was a prop trader for almost exactly 15 years to the month. So I have a lot of experience with the sort of trading a lot of your viewers do. But I kind of evolved my career into a more institutional role. And as I did it, I learned a lot of things I would have never learned if I remained a prop trader. But that said, I was always systematic. I was always equation driven. And a lot of it had to do with the mechanisms of the vehicles I traded. And I think that's a really interesting way to trade, to focus on the features of the instruments, the embedded options, and the rebalancing features. It's a much more, I think, comfortable and reliable way to generate profits than trying to predict short-term movements.
So, Michael, I agree with what you're saying, and a lot of traders that trade in our community and throughout the markets, they tend to be very rule-based. But based on your experience, how often do you have to change up your strategies based on current market conditions? Because in this world, as you know, the market shifts so quickly. Information gets around so fast, and it seems like what used to take months and maybe even quarters to develop, they could develop, moves can develop rather quickly in this environment. So how often do your models change?
You're absolutely right about that. And I have 2 points to make related to that. One, it's the models change really fast, right? With high frequency trading, things are done on a sub-second level that I used to do by hand. When I started trading, I had 2 phones, one in each ear. I had 30 computer screens in front of me because Windows was barely a thing and you couldn't switch screens anyway. And I had squawk boxes on my desk, like actual speakers with microphones. And, we responded to the market. Now bots do all that stuff really quickly. But I think really the important answer to that question is you change your strategy when your thesis is violated. And a lot of people, they know that, but they forget. And what you really need to do is when you define a trade, you also define what rules confirm it, what disconfirm it, and what your targets are. And so if you're losing money, you shouldn't get out of a trade unless your thesis is violated. If you made a lot of money, you should get out of the trade if it exceeds your target, right? You shouldn't gamble. You shouldn't bet on things that you have no comfort in. You should stick to the plan. And that's kind of the essence of the book and the way I've always been taught to trade.
Okay, so that makes a lot of sense to me as a trader, and most of us do this in our heads. We have a what called a checklist, whether it's mental or a computer driven checklist of certain boxes that need to be ticked. But what you're saying is there is a risk as a trader that your emotions are going to take over, because once you're in the trade, you're in the trade, and once you're in the trade, you can push a lot of rules to the side because you're gonna be looking for confirmation of that confirmation bias all the time from everywhere. Is that correct?
Absolutely. And there's an extension to that point. And when I was a prop trader, I was managed by traders and they understood those stresses and they gave me room to do what I need to do. But as my career evolved, my managers were no longer traders and they were very susceptible to emotions. Right. So when the portfolio started losing money, when they perceived that things weren't going our way, they put a lot of pressure on me to break my strategy. And that's, I think, where systematization really helps out. If you backtest many different scenarios, many different situations, say you have a trailing stop, you backtest various different parameters for those stops, that gives you a lot of ammunition and a lot of staying power. You could say to the board of directors or whoever it is you report to, look, we've got this. We tested this. We studied this. We spent months figuring out how to make the strategy work, even under the situation we're under now. And just because you're afraid and nervous is not a good reason to just throw all that research out the window. And so by doing that research, it not only helps you handle your emotions, but more importantly, it helps you manage the people around you who are threatening to push you out of your comfort zone.
Yeah, I think those of us that have traded for prop firms probably we know that we know that feeling as they're sitting on your shoulder, and rightfully so. Managing their risk with you, it's definitely could be it could wear on you as a trader psychologically. So let me ask you this: when you're talking about your book, let's dig into your book a little bit. What type of systems do you use, like physically? What type of systems do you use, and what type of assets are you managing currently, or is in your purview, if you will?
Well, lots of different kinds of assets. In fact, there's one chapter that is a bit hard to read, but the point of it is to show all these different assets. And the reason why I thought it was important is because when people do research on the internet about factors and factor-based investing, they really often only focus on like the big ones, the Fama and French factors, and also mostly on stocks and ETFs. But the world is so much bigger than that, right? There's all sorts of other instruments out there, debentures and preferred stocks and convertibles and AT1s, right? There's tons of different stuff you can invest in. And I think that's a really important point, and a point that I continually make is that if you're competing against the most popular, most liquid, most available assets and factors, then your competition is too fierce, right? There's just too many people to compete against. But if you find a niche in the market, one thing that maybe not a lot of people are looking at, you really increase your chances. And that's really what I did for my first 15 years. We did arbitrage, and people in the bulge bracket banks, they could have swooped in and taken our business away from us very easily, but it didn't pay, right? They needed a much bigger trade to make it worth their while. So they kind of left us alone, and we made tons of money, just not enough, for them.
Yeah.
Right. Another good example is a friend of mine was a So's Bandit. Do you remember that?
Oh, that would be me. Yes.
Did you do that?
Back 1996. Yes. Guilty as charged. Yes.
Right. So that was your business model, right? You had a niche that the market makers, it wasn't in their best interest to look at the So's before the NASDAQ too, right? And that's how you made money. That's exactly how I feel about all these different assets. If you dig deep into a niche, you open up an opportunity.
Michael, you as you pointed out, is a really big world now, and there's so many different assets and vehicles that you can trade in. How much does correlation, even though we all know correlation is not causation, but how much does correlated markets and instruments factor into your quantitative style, if you will?
It factors in a lot of different ways. So one thing we do is we use optimization, but as you know, it's really difficult to do right. You learn it in school, and then a lot of people abandon it because there's a lot of reasons why it doesn't work well. But there are a lot of ways to fix it as well. And obviously that involves correlation and covariance. Another really important point with correlation is Granold and Kahn's fundamental law of active management, right? One of the big determinants, one of the easiest things to do to increase your alpha is to expand your universe, to invest in other things. But it doesn't pay to invest in other things if they're really highly correlated. You might as well invest in one thing. And importantly, correlation is time varying, right? So you can't just take a snapshot of correlation when times are good, and then in a crisis, they all increase to unity and everything's the same anyway, so who cares, right? So correlation is really important. Time varying correlation is really important. And there are such great tools available now. I mean, they've been available for a while, but they're very easy to use now, like time series GANs to try to simulate synthetic price action and try to figure out how to manage those correlations in the situations that you'll encounter and that you're worried about, rather than just using the data that you have and looking backward. So it's really an exciting, interesting area of research.
It really is. I feel like I'm already excited to go down in the deep rabbit hole with Mr. Michael Robbins already in your book. But before we talk about that, I want to ask you one last thing from a trading perspective, because you, like you said, you obviously you manage and advise very large amounts of money, but also you've prop traded, which would be a big part of our trading community here. How important would you say is risk management to your success in the financial markets?
It's absolutely huge. In one of my past jobs was the chief risk officer of a state pension system. And a friend of mine, Devin, who wrote a quote in my book, he used to be the president of Standard & Poor's, actually talked about the book as a risk management tool. And it's like the old phrase goes, a penny saved is a penny earned. It's a lot easier not to lose money than to make it back after you lost it. And so risk management is really important, especially, as you mentioned, if you work for a prop trading firm, that's what they care about, right? They don't care if you make money. They just want to make sure you don't lose their money. And it's really important. And it's very interesting too, because a lot of people look into, say, the Kelly criterion system, right? Of wealth maximization. And that's really compelling. And some people do use it. The drawback is that you open yourself up to a lot of risk, and maybe you ruin your chances before your profits accumulate.
Sure.
And that's why people sometimes do use things like optimization to manage their risk, because they can't manage the Kelly system enough, for their purposes. So yeah, risk management is the key to longevity. It doesn't matter how good you are if you blow out.
That's right. I don't think there could be truer words in the market. Well, Michael, tell us a little bit about your book. I'm going to tell you right now, I'm going to go ahead and put myself on the Amazon list and get it shipped out to me at the end of this month. But tell us a little bit about your book and what can we expect as traders and the financial community with what we're going to read.
Yep. So the whole idea behind the book is to do the sort of things I just mentioned, to open up people's experience to what I've learned. And I've been around a while. Maybe I've seen some things, some different things than some readers. I hope that any reader might pick something up, no matter how experienced they are. And a lot of it is applying these things that maybe you tried but didn't work out, or you tried but you might not know all the nuances about, and specifically how to use technology to invest. Not as a technologist, not as a programmer. There are some books that are written about how to do these things from a technology standpoint. I show you from an investment management standpoint. And if there's an easy way to do something that's not as technologically sophisticated or elegant, that's fine. That's not my point. My point is to get the answer. And I use some very specific technologies, but I don't get very into the specifics of how to apply it, but more the different ways you should look at a problem, the different things you can consider, taxes, fees, costs, things like fence post errors, how to handle minority data or oversampling, things like that. Without getting too much in the detail, I'm actually working on a second companion book that explains how to do those things specifically, because I've trained hundreds of people on how to use them, and I've seen the mistakes they make and how they get stuck. And I think there's a market also for a book to say, all right, well, you read the first book of what you should consider. Here's a book of like how to do it.
Yeah.
So unfortunately, people who want to read the book and know like step by step, here's how you install this library, here's how you download this data. I don't get into that kind of detail. What I do say is, this is how you might have done it in the past. These are the things you might have missed. And a lot of times I think the readers will say, I didn't even know to consider that. That's something that's great. Like one example that I love is people have been trying to write computer programs to do technical analysis forever, right? Since computers were used on Wall Street.
Forever,
it's really hard, right? It's really hard. But there was a novel, I think it happened about 10 years ago. Somebody said, well, computers are really good at looking at visual data. So why don't we take an image of a technical analysis pattern, feed it into a GAN, and then feed it images of price action and see if it could figure out how to use technical analysis from the image, right? And that was pretty interesting. So there's lots of really novel ways to look at problems that play into the strengths of technology that maybe I'll give some people some ideas and they'll run with it and create some really profitable ideas.
Well, I love it, Michael. And just so everybody has this, it's the Quantitative Asset Management, Factor Investing, and Machine Learning for Institutional Investing, published by McGraw Hill, and it's going to be out the end of June, if I got that correct. Now, I know you have a website, which is quantitativeassetmanagement.com, but are there other ways for traders to follow your work and what you do?
That's where I'm trying to consolidate everything. And that points to other resources. And I'm working hard to build it out, and it'll be built out continuously. I'm adding videos like this one. I'll add instructional videos. I'm posting code and data, and where I use a lot of professional, intellectually protected data. So in those cases, I'll add computer scripts on how to download the data, which is incidentally a lot harder than it sounds. To get the data correctly, to put the proper switches in the data. So for instance, if you want to download Bloomberg data, you have to be very careful. You have to include not only normal adjustments, but abnormal adjustments, or you get the wrong total return. So there's a lot of tricks I include that were hard-earned that people may not even know to look for in the scripts and in the data and in the programs that I post on the site. So hopefully a lot of people will avoid making some very costly mistakes by reading the book and downloading the software.
Well, I can tell you this much. I am not a nuclear physicist, so going to your site sounds like the best bet for myself. And I hope for everybody out there. And you can get to the site. If you're watching us on the Traders Summit site, you can click on Michael's bio. It's going to take you directly there. Also, we should have a link to that in the YouTube video down below. If you guys and gals have enjoyed listening to Michael and him talk about his book and quantitative asset management, make sure you give him a big thumbs up. Jump in the comments down below if you have any comments for him. Michael, I want to say it's been a real pleasure, Professor, for having you here today with the Traders Summit community. I want to thank you so much for being with us, and I'd like to have you back again sometime.
I love that. Thank you very much.
All right. Have a great day, and best of luck to you.
Thank you. You too.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.